The mistake I am referring to is this: confusing speculation with investing. You see, there is a difference, a very important difference. And when you fail to understand that difference, you are not investing at all. You are gambling. And the house always wins when you gamble. I am going to share something with you today that might save you decades of financial regret. There is one mistake, one critical error that has destroyed more wealth than any market crash in history. And I see investors making this exact same mistake right now, today, as I speak to you. It cost people trillions in 1999. It cost them fortunes in 2008, and it is happening again. The mistake is confusing speculation with investing. And if you do not understand the difference between these two things, you are going to lose money. So let me explain exactly what this mistake is, why smart people keep making it, and most importantly, how you can avoid it and build real, lasting wealth instead. Well, hello there. Thank you for joining me today. You know, I have been investing for a very long time now, more than 7 decades, in fact. And in all those years, I have seen the same mistake made over and over and over again. Different faces, different generations, different technologies, but the same fundamental error in judgment. And it is an error that has destroyed more wealth than any market crash, any recession, or any economic disaster you can name. Now, I am not talking about picking a bad company. That happens. We all make mistakes. I have made plenty of them myself. I am talking about something far more dangerous, something that seems to infect investors during certain periods of history, like a fever that spreads from person to person until nearly everyone has lost their senses. The mistake I am referring to is this: confusing speculation with investing. You see, there is a difference, a very important difference. And when you fail to understand that difference, you are not investing at all. You are gambling. And the house always wins when you gamble. Let me be very clear about what I mean. When you invest, you are putting money into an asset because you understand what that asset is worth. You have done your homework. You know the business. You know how it makes money. You know what it owns. You know what it owes. And you have determined that the price you are paying today is less than what the asset is actually worth. That is investing. Speculation, on the other hand, is when you buy something not because you understand its value, but because you think someone else will pay you more for it tomorrow. You are not analyzing the business. You are analyzing the psychology of other market participants. You are trying to guess what the crowd will do next. And that, my friends, is not a game you want to play. Now, I understand the temptation. I really do. When you see your neighbor buying some hot stock and it doubles in a month, it is hard to sit on the sidelines. When you hear about people making fortunes in cryptocurrencies or meme stocks or whatever the latest craze happens to be, you feel like you are missing out. You feel like everyone else knows something you do not. But here is what I have learned over 7 decades. Those people who are bragging about their quick profits, they are not telling you about all the times they lost money. They are not showing you their full portfolio. They are cherry-picking their wins and staying quiet about their losses. And more importantly, they are playing a game that cannot be sustained. Eventually, the music stops. The greater fool does not show up. And all those paper profits evaporate like morning dew in the Nebraska sun. I have seen this happen so many times I have lost count. I saw it in the 1,960 seconds with the go-go stocks. I saw it in the 1,970 seconds with the Nifty 50. I saw it in spectacular fashion in the late 1,990 seconds with the dot-com bubble. And I have seen it again and again in recent years with various manias and crazes. The details change. but the story is always the same. Prices rise far above any reasonable estimate of value. People convince themselves that this time is different. They invent new metrics and new rationales to justify absurd valuations, and then, inevitably, reality reasserts itself, prices collapse, fortunes are lost, and the same investors who thought they were geniuses are left wondering what happened. Now, here is what troubles me most. It is not just that people lose money. Money can be earned back. What troubles me is that people lose years. They lose decades. They spend the best years of their investing lives chasing illusions instead of building real wealth. They could have been compounding their money at reasonable rates in solid businesses. Instead, they were gambling on hype and hope. And that is a tragedy. So today, I want to talk to you about this mistake. I want to explain exactly what it is, why it is so seductive, why it is so destructive, and most importantly, how you can avoid it. Because if you can avoid this one mistake, you will be ahead of 90% of the people out there trying to make money in the markets. Are you ready? Good. Let us begin. Let me tell you a story. Back in 1999, I was sitting in Omaha watching the world go crazy. The internet had arrived, and with it, a new breed of investor who believed that all the old rules had been thrown out the window. People were paying 50 times, 100 times, sometimes 200 times sales for companies that had never made a single dollar of profit. Not earnings, sales, and in many cases, these companies did not even have a clear path to profitability. They were just burning cash and hoping to get big fast. I remember attending a conference where a young man stood up and told me I was out of touch. He said I did not understand the new economy. He said the price-to-earnings ratios were obsolete. He said that in the internet age, all that mattered was eyeballs and clicks and network effects. I asked him a simple question. I said, at the end of the day, does this business generate cash for its owners, or does it consume cash? He looked at me like I was speaking a foreign language. Well, we all know what happened next. The bubble burst. Trillions of dollars of paper wealth vanished. Companies that had been worth billions went bankrupt. And that young man who thought I was out of touch, I do not know what happened to him, but I am guessing he learned an expensive lesson. Now, here is the thing that fascinates me about these bubbles. They always feel different when you are inside them. The people participating always believe they have good reasons for what they are doing. They point to real technological changes. They cite impressive growth rates. They talk about paradigm shifts and new eras. And you know what? Sometimes they are partially right. The internet was a real innovation. It did change the world. But that does not mean you should pay any price for an internet company. Amazon was a real business with real potential even in 1999. But if you bought it at the peak, you had to wait nearly a decade just to get back to even. And that is one of the survivors. The railroad revolutionized America in the 1800s. Radio revolutionized communication in the 1,920 seconds. Television revolutionized entertainment in the 1,950 seconds. All of these were real transformative technologies, and all of them created spectacular bubbles where investors lost fortunes because they confused a good technology with a good investment at any price. You see, there is a huge difference between saying this technology will change the world and saying this stock is a good investment at this price. The first statement might be true, but the second statement requires careful analysis of what you are paying versus what you are getting. Let me give you an analogy. Suppose you walk into a store and you see a wonderful coat. It is well made, it fits perfectly, it will keep you warm for many winters. That is a quality product. But if the store is charging you $10,000 for that coat, when you could buy an equally good coat down the street for $200, are you making a smart purchase? Of course not. The quality of the coat does not justify any price. You have to think about what you are paying versus what you are receiving. The same principle applies to stocks. I do not care how good the company is. I do not care how revolutionary the technology is. If you are paying a price that cannot be justified by the cash flows that business will generate over its lifetime, you are speculating, not investing. Now, I know what some of you are thinking. You are thinking, but Warren, some of these companies do not have cash flows yet. They are growing, they are investing in the future. You have to look at what they will be worth someday. And that is true to a point. When we bought See's Candies back in 1972, we were paying for future earnings, not just current earnings. But here is the key. We could see a clearer path to those future earnings. We understood the business. We knew the economics of selling candy. We could estimate with reasonable confidence what the company would earn over time. We were not hoping. We were not guessing. We were calculating. And that is the difference. When you invest, you are making a rational calculation about value. When you speculate, you are making a guess about what other people will pay. One of these approaches works over time, the other does not. So why do smart people fall into the speculation trap? Well, there are several reasons, and I want to walk through them with you, because if you understand why this mistake is so seductive, you will be better equipped to avoid it yourself. The first reason people speculate is simple: greed. Now, I do not mean that in a judgmental way. Greed is a natural human emotion. We all want more, we all want to get ahead, and when you see prices rising rapidly, when you see other people making money, your brain starts to whisper to you. It says, you could have that too. You could double your money in a month. You could retire early. All you have to do is get in. That voice is very seductive, and it becomes louder and louder the longer the bubble continues. The person who resists at first starts to feel foolish. Everyone around them is getting rich, and they are sitting on the sidelines. The social pressure becomes immense. I saw this very clearly in the late 1990 seconds. People at cocktail parties would talk about their stock portfolios the way they used to talk about their golf games. Everyone had a story about some stock that had tripled. And if you were not participating, you felt like a fool. You felt like you were missing the opportunity of a lifetime. But here is what they were really missing. They were missing the opportunity to preserve their capital for when prices became reasonable again. They were missing the opportunity to buy wonderful businesses at fair prices instead of mediocre businesses at insane prices. The second reason people speculate is fear. Fear of missing out. We have a fancy acronym for it now. They call it FOMO. But it is not a new phenomenon. It has been around as long as markets have existed. When you see your neighbor make money, when you see your coworkers make money, when you see strangers on the internet posting screenshots of their gains, you start to panic. You start to think that if you do not get in right now, immediately, you will miss your chance forever. The train is leaving the station, and you had better jump on board before it is too late. This fear overrides your rational judgment. You stop asking the important questions. You stop doing the math. You just buy because everyone else is buying. I have to tell you, some of the worst investment decisions I have ever seen were made by people acting out of fear of missing out. They bought at the peak. They paid the highest prices. And then they held on as their investments declined 50%, 70%, sometimes 90% or more. The third reason is ignorance. And again, I do not mean that as an insult. I mean that many people simply do not know how to value a business. They were never taught. Nobody ever sat them down and explained the difference between price and value. Nobody ever showed them how to read a financial statement or calculate a discount rate or estimate future cash flows. So when they see a stock going up, they assume it must be a good investment. The price is rising, so it must be worth buying. They confuse the scoreboard with the game itself. It is like watching a football match and thinking that whichever team is ahead at halftime will necessarily win the game. Sometimes they do. Often they do not. The score at any given moment is just information. It is not a prediction of the final outcome. The fourth reason people speculate is overconfidence. This is particularly common among smart, successful people. They have done well in their careers. They have made good decisions in other areas of their lives. And they think that intelligence and success in one domain will automatically translate to success in investing. But investing is a specific skill. It requires specific knowledge. And it requires something that many intelligent people struggle with: patience and humility. I have seen doctors, lawyers, engineers, and executives make terrible investment decisions because they thought they were smarter than the market. They thought they could outsmart everyone else. They thought the rules did not apply to them. But the market does not care how smart you are. The market does not care about your degree or your title or your track record in other fields. The market only cares about one thing. Are you paying a reasonable price for what you are getting? And if you are not, the market will eventually teach you a very expensive lesson. The fifth reason, and perhaps the most insidious, is the way our brains are wired. Human beings are pattern-seeking creatures. We see patterns even when they do not exist. When we see a stock go up 5 days in a row, we start to believe it will go up on the 6th day. When we see a sector perform well for a year, we project that performance into the future. But past performance in the stock market, especially over short time periods, tells you almost nothing about future performance. A stock that has doubled in the last year might double again, or it might fall by half. The past movement of the price tells you nothing about whether the current price is reasonable. Yet our brains keep searching for patterns. We keep trying to find the secret formula. We keep thinking that if we just look at the chart the right way, or if we just follow the right indicators, we can predict what will happen next. It is a fool's errand, but it is a very tempting fool's errand. Now, let me talk about what speculation actually costs you, because the damage goes far beyond just losing money on a single trade. The most obvious cost is the direct loss of capital. When you buy something at an inflated price, and then the price returns to reality, you lose money. Simple as that. If you paid $100 for something worth $50, you just lost $50. That is painful. But it is not the worst part. The worst part is the opportunity cost. That $50 you lost could have been invested in something reasonable. It could have been compounding over the years. It could have been growing steadily in a solid business that you understood. Let me give you some numbers to make this concrete. Suppose you had $10,000 in 1999. You had two choices. You could put it into an index fund tracking the S&P 500, or you could put it into the hot .com stocks that everyone was talking about. If you chose the index fund and you held it through thick and thin, reinvesting your dividends, that $10,000 would have grown to about $60,000 by today. Not spectacular, but solid. That is approximately a 7.5% annual return, which is right around the historical average for stocks. But what if you bought into the .com mania at the peak? Well, many of those companies went to zero. They do not exist anymore. Even if you had diversified among several of them, you likely lost 70, 80, maybe 90% of your money. And then you had to start over with whatever scraps remained. So instead of having $60,000 today, you might have $2,000 or less. That is the cost of speculation. That is what happens when you confuse a hot stock with a good investment. But the financial cost is not even the most tragic part. The most tragic part is the psychological damage. When you lose money through speculation, it does one of two things to you. Either it makes you afraid of the stock market entirely, so you never invest again and you miss out on legitimate wealth-building opportunities, or it turns you into a perpetual gambler, always chasing the next big score, always trying to win back what you lost. Neither of those outcomes is good. I have known people who lost money in speculative bubbles and swore off stocks forever. They kept their money in savings accounts, earning 1 or 2%, watching inflation eat away at their purchasing power year after year. They let one bad experience rob them of decades of potential returns. And I have known people who went the other way. They became addicted to the excitement of speculation. They were always looking for the next lottery ticket. They would win occasionally, which would reinforce their behavior. But over time, they systematically destroyed their wealth through a series of bad bets. Both types of people made the same fundamental mistake. They did not understand the difference between investing and speculating, and that lack of understanding cost them dearly. Let me tell you about a specific example. There was a company called Pets.com during the dot-com bubble. They sold pet supplies online. They had a cute sock puppet mascot that appeared in Super Bowl commercials. Everyone knew about Pets.com. The stock was hot. People were excited. The company went public in February of 2000. The stock opened at $11 per share. It briefly climbed higher, and then 9 months later, the company shut down, completely out of business. The stock went to zero. Now, if you had done even basic analysis of that business, you would have seen the problems immediately. They were selling low-margin products, heavy items like dog food and cat litter, and trying to ship them to customers' homes. The shipping costs were often higher than the profit margins on the products. They were losing money on every sale and trying to make it up in volume, which is not a strategy, it is a recipe for bankruptcy. But people did not analyze the business. They just saw a hot stock in a hot sector, and they bought, they speculated, and they lost everything. You might think that was a long time ago. You might think we have learned our lessons since then, but I am here to tell you, we have not. The names change, the technologies change, but human nature does not change. Speculation is alive and well today, just wearing a different costume. In recent years, I have watched people pour money into cryptocurrencies that have no intrinsic value, no earnings, no assets, nothing but the hope that someone else will pay more tomorrow than you paid today. That is not investing. That is speculation in its purest form. I have watched people bid up the prices of meme stocks, not because they understand the businesses or believe in their futures, but because they want to be part of a social movement or because they think they can outsmart the system. Again, that is speculation. I have watched people pay extraordinary prices for companies that are growing rapidly but have no clear path to profitability, believing that growth alone justifies any valuation. History tells us otherwise. The cycle repeats because each new generation thinks they have found something different, something new, something that changes all the rules. But there is nothing new under the sun. The rules of investing do not change. Value matters, price matters, cash flows matter. Paying attention to what you are buying and what you are paying for it matters. Everything else is just noise. So how do you avoid this mistake? How do you protect yourself from the seduction of speculation? Let me share with you the principles that have guided me for more than 7 decades. The first principle is this: only invest in businesses you understand. I call this your circle of competence. Stay within it. Now, that does not mean you need to be an expert in technology or pharmaceuticals or banking to invest in those sectors. What it means is that you need to understand how the business makes money. You need to understand its competitive position. You need to understand what could go right and what could go wrong. If someone tries to pitch you an investment and you cannot explain in simple terms how the company generates cash, you should not invest. I do not care how exciting it sounds. I do not care how much everyone else is making. If you do not understand it, Stay away. I have missed out on a lot of investments over the years because they were outside my circle of competence. I did not buy Microsoft in the early days, even though Bill Gates is a good friend of mine. I did not understand the technology sector well enough to value those businesses with confidence. Did I miss out on profits? Sure, but I also avoided a lot of mistakes. And here's the key. You only need a few good investments in your lifetime to do very well. You do not need to swing at every pitch. In fact, in investing, unlike baseball, you do not have to swing at all if you do not see a pitch you like. There are no called strikes. You can wait for the perfect pitch, the one right in your sweet spot, and then swing with confidence. The second principle is to focus on intrinsic value, not market price. Intrinsic value is what a business is actually worth based on the cash it will generate over its lifetime. Market price is what other people are willing to pay for it today. Sometimes these two numbers are close together. Often they are not. Your job as an investor is to estimate intrinsic value as best you can, and then only buy when the market price is significantly below that estimate. That gap between price and value is what I call the margin of safety. It is your cushion. It is your protection against errors in your analysis or unexpected events. How do you estimate intrinsic value? Well, it is not as complicated as Wall Street wants you to think. At its core, a business is worth the sum of all the cash it will generate in the future, discounted back to the present. If you can make a reasonable estimate of those future cash flows, you can make a reasonable estimate of value. Now, for some businesses, that is relatively easy. If a company has been generating steady cash flows for many years, if it operates in a stable industry, if it has a durable competitive advantage, you can project future cash flows with reasonable confidence. For other businesses, it is much harder. If the company is in a rapidly changing industry, if it has not yet proven it can generate consistent profits, if it faces intense competition, estimating future cash flows becomes much more speculative. And when the estimate becomes too speculative, the right answer is often to simply move on to something easier. Remember, you do not get paid for difficulty. You get paid for being right. So why make it hard on yourself? Why not focus on businesses where the analysis is straightforward? The third principle is to think like an owner, not a trader. When you buy a stock, you are buying a piece of a business. You are becoming a partial owner. You are entitled to your share of everything that business earns from now until forever. So the question you should ask yourself is, would I be happy owning this entire business at this price? If the stock market closed tomorrow and did not reopen for 10 years, would I be comfortable owning this business for that entire period? If the answer is no, you should not buy the stock. It does not matter if you think the price will go up next week or next month. If you would not want to own the business long term, you are not investing. You are speculating on short-term price movements. When we bought Coca-Cola stock in the late 1980 seconds, we did not buy it because we thought the stock price would go up. We bought it because we wanted to own a piece of a wonderful business. We wanted to own a share of every Coke sold around the world. We wanted to participate in the earnings of that franchise. And you know what? We still own that stock today, more than 35 years later. We have collected dividends every quarter. We have watched the business grow. We have benefited from the compounding of intrinsic value over time. That is investing. That is how you build wealth. The fourth principle is to be patient. This might be the hardest principle of all, because patience is not rewarded in our modern culture. We live in a world of instant gratification. We want results now. We want to get rich quickly. But investing does not work that way. Good investments take time to mature. Intrinsic value grows gradually as the business compounds its earnings year after year. You cannot rush the process. Think about a tree. When you plant an oak tree, you do not stand there every day measuring how much it has grown. You do not dig it up every week to check on the roots. You plant it, you water it, you give it time, and nature does the rest. 20 years later, you have a magnificent oak tree. Investing works the same way. You find a good business at a fair price, you buy it, and then you let time and compounding do the heavy lifting. But most people cannot do this. They check their portfolios every day. They panic when prices go down. They get excited when prices go up. They buy and sell based on emotions rather than rational analysis. This constant activity is the enemy of returns. Every time you sell, you pay taxes. Every time you trade, you pay commissions and spreads. More importantly, every time you trade, you risk making a mistake. You risk selling a good business too early or buying a mediocre business at the wrong time. I have said before that our favorite holding period is forever. And I mean that quite literally. If we buy a wonderful business at a fair price, why would we ever sell it? We want to collect our share of the earnings for as long as possible. We want the miracle of compounding to work in our favor. Now, I am not saying you should never sell. If you make a mistake in your analysis, if the business fundamentally changes, if you find a significantly better opportunity, then selling might make sense. But selling just because the stock has gone up, or just because you are bored, or just because you want to lock in a profit, those are not good reasons. Charlie Munger, my longtime partner, likes to say that the big money is not in the buying and selling, but in the waiting. And he is absolutely right. The investors who have done best over the long run are not the ones who traded the most or who had the most sophisticated strategies. They are the ones who found good businesses and had the discipline to hold them. The fifth principle is to ignore Mr. Market. This is a concept from Ben Graham, my mentor. Mr. Market is a metaphor for the stock market itself. Imagine that you are in business with a partner named Mr. Market. Every single day, Mr. Market comes to you with an offer to buy your share of the business or to sell you his share. Some days, Mr. Market is optimistic and enthusiastic. He offers you a very high price for your share, far more than you think the business is worth. Other days, Mr. Market is depressed and pessimistic. He offers you a very low price, far less than the business is actually worth. Now, you are under no obligation to trade with Mr. Market. You can simply ignore him if his prices do not make sense. But here's the beautiful part. When Mr. Market offers you a ridiculously low price, you can buy from him. And when he offers you a ridiculously high price, you can sell to him. The key insight is that Mr. Market is there to serve you, not to guide you. His job is to provide you with opportunities, not to tell you what to think. Yet most investors get this backwards. They let Mr. Market's moods dictate their decisions. When Mr. Market is euphoric and prices are high, they get excited and buy. When Mr. Market is depressed and prices are low, they get scared and sell. This is exactly backwards. You should be greedy when others are fearful, and fearful when others are greedy. During the financial crisis in 2008 and 2009, Mr. Market was terrified. Prices of wonderful businesses fell to levels that made no sense if you believed those businesses would survive, which I did. So we bought aggressively. We put capital to work when everyone else was running for the exits. Were we scared? Of course. It was a scary time. The entire financial system seemed to be teetering on the edge of collapse. But we kept our focus on value, not on fear. We asked ourselves, what are these businesses actually worth? And we realized that Mr. Market was offering us bargain prices. The opposite was true in 1999. Mr. Market was euphoric. Prices were absurdly high. People were paying astronomical valuations for companies with no earnings, no profits, just hopes and dreams. So we did not buy. We sat on the sidelines with cash waiting for better opportunities. People criticized us at the time. They said we were out of touch. They said we did not understand the new economy. They said we were missing the boat. But we were not missing anything. We were simply refusing to overpay. And when the bubble burst, when prices returned to reality, we still had our capital intact. We were ready to invest when prices made sense again. That is the power of ignoring Mr. Market's emotional swings and focusing on value. The sixth principle, and this is critical, is to be honest with yourself. Investing requires a level of intellectual honesty that most people find very difficult. You have to be willing to admit when you are wrong. You have to be willing to acknowledge your mistakes. You have to be willing to say, "I do not know," when you do not know. The worst investors I have ever met are the ones who cannot admit their mistakes. They double down on bad investments, throwing good money after bad, because admitting the loss would be too painful. Or they blame external factors, the market, the economy, bad luck, anything except their own poor judgment. But if you cannot be honest with yourself about your mistakes, you will never learn from them. And if you never learn, you will keep making the same errors over and over again. I have made my share of mistakes over the years. I can tell you about them quite freely now, because I learned from every single one. I bought a textile mill in New England back in the 1960 seconds. It was called Berkshire Hathaway. I thought I was getting a bargain, and on paper I was. The assets were worth more than the stock price. But what I failed to fully appreciate was that it was a terrible business in a dying industry. No matter how cheap you buy a bad business, it is still a bad investment. I eventually figured this out, but it took me years and cost me a lot of opportunity cost. That money could have been deployed in wonderful businesses instead of being tied up in a mediocre textile operation. Now, the story had a happy ending because we eventually transformed Berkshire into an insurance and investment company. But the lesson remains: a bargain price does not make up for a bad business. It is far better to buy a wonderful business at a fair price than a fair business at a wonderful price. I have also made mistakes by not acting. Some of my biggest errors were not the stocks I bought that went down, but the stocks I did not buy that went up. I watched Google grow into one of the dominant companies in the world, and I did not buy it because I thought I did not understand the business well enough. In hindsight, it was more understandable than I thought. But here is the thing about mistakes of omission versus mistakes of commission. When you buy a bad stock, you lose the money you invested. But when you fail to buy a good stock, you only lose the opportunity. Your capital is still intact. You can still invest it elsewhere. So while both types of mistakes are costly, I would rather make mistakes of omission than mistakes of commission. I would rather miss out on profits than lose capital. The seventh principle is to maintain a margin of safety. I mentioned this earlier, but it is so important that I want to come back to it. The margin of safety is the foundation of sound investing. Here is what it means in practice. Let us say you estimate that a business is worth $100 per share. You have done your homework. You have analyzed the financials. You have considered the competitive position. You have estimated future cash flows. And your best estimate of intrinsic value is $100. Should you buy the stock at $95? After all, that is below your estimate of value. You would be buying at a discount, right? Well, maybe, but I would argue that $5 is not enough of a margin of safety. Your analysis could be wrong. Your assumptions could be too optimistic. The business could encounter unexpected problems. A 5% discount does not give you much room for error. But what if the stock was trading at $65? Now we are talking. You have a 35% margin of safety. Even if your analysis is off by 20%, you are still buying at a discount. Even if the business encounters problems, you have a cushion. That is when I get interested. That is when I am willing to commit capital. The margin of safety protects you in two ways. First, it protects you against errors in your analysis. Nobody is perfect. We all make mistakes in our estimates. The margin of safety gives you room to be wrong and still make money. Second, it protects you against bad luck. Even good businesses can encounter temporary problems. Economic downturns happen. Competitors emerge. Management makes mistakes. If you paid a full price with no margin of safety, these problems can turn a good investment into a loss. But if you bought with a significant discount, you can weather the storm. The eighth principle is perhaps the simplest, but also the most profound. Do not lose money. This is rule number one. Rule number two is do not forget rule number one. Now, I know what you are thinking. Of course nobody wants to lose money. That goes without saying. But I mean something deeper than just the obvious desire to make profits. What I mean is that you should structure your investments so that permanent loss of capital is highly unlikely. Not impossible, because nothing is certain in this world, but highly unlikely. How do you do that? You do it by following all the other principles I have discussed. You stay within your circle of competence. You insist on a margin of safety. You think like an owner. You ignore Mr. Market's emotional swings. You are patient. You are disciplined. You are honest with yourself. When you do all of these things, the odds of permanent capital loss become very small. You might have temporary paper losses. You might have to watch your stocks go down for a period of time. But if you bought good businesses at reasonable prices, you can hold through the volatility and come out ahead in the end. The reason this principle is so important is mathematical. If you lose 50% of your capital, you need to make 100% just to get back to even. The math of losses is brutal. It is much easier to avoid losing money in the first place than to try to make up for losses later. This is why I am so conservative in my approach. This is why I insist on understanding what I am buying. This is why I insist on a margin of safety. This is why I avoid speculation. Because my first job, my most important job, is to not lose your money. Let me give you some practical examples of how these principles work in the real world. Because theory is one thing, but application is what matters. Consider Coca-Cola, which I mentioned earlier. When we bought our position in the late 1982, Coca-Cola was not a hot growth stock. It was not the talk of cocktail parties. It was not doubling every month. It was a mature, established business that had been around for over a century. But it was a wonderful business. It had a product that people loved and that had not changed in any meaningful way in decades. It had a brand that was recognized all over the world. It had a distribution system that would be nearly impossible for a competitor to replicate. And it was selling at a reasonable price relative to its earnings and cash flows. So we bought it, not because we thought it would double in a year, but because we wanted to own a piece of that franchise for the long term. We wanted to collect our share of every Coke sold around the world. We wanted to participate in the slow, steady compounding of that business. And that is exactly what happened. The stock did not go straight up. There were years when it went down. There were periods when other stocks were more exciting. But over the long term, we have done very well because we owned a wonderful business at a fair price. Compare that to the speculation that went on during the dot-com bubble. People were buying companies that sold pet supplies online, or companies that delivered groceries, or companies that did not even have a clear business model. They were paying astronomical prices, not because the businesses were wonderful, but because they thought the stock prices would keep going up. Those were not investments. Those were bets and most of those bets lost. Let me tell you about another example. There was a time in the 1,970 seconds when everyone wanted to own what they called the Nifty 50. These were 50 large, established companies that were considered so solid, so reliable, that you could supposedly buy them at any price and hold them forever. Companies like Polaroid, Xerox, Kodak, and others. Good companies, many of them. But people paid such high prices that even though the companies performed reasonably well, the investors lost money. They paid 50 times earnings, 60 times earnings, in some cases even more. At those valuations, even a good company cannot deliver good returns. Polaroid was trading at over 90 times earnings at one point. Think about that. Even if the company grew its earnings at a healthy rate for years, it would take decades just to justify that valuation. And of course, Polaroid eventually faced disruption from digital photography. The company went bankrupt. Investors lost everything. The lesson is not that these were bad companies. The lesson is that price matters. Valuation matters. You can destroy your wealth by overpaying for even a good business. Now, let me address something that I hear quite often, especially from younger investors. They say, "Warren, the world has changed. Technology is changing everything. The old rules do not apply anymore. You have to pay up for growth. You have to pay up for innovation." And my response is always the same. The world has always been changing. Every generation thinks their changes are unprecedented. But the fundamental principles of investing do not change. Yes, technology is important. Yes, innovation creates opportunities. But that does not mean you should pay any price. It does not mean you should abandon rational analysis. It does not mean the laws of mathematics have been suspended. A business is worth the cash it will generate over its lifetime. That was true 100 years ago. It is true today. It will be true 100 years from now. The specific technologies change. The specific industries change. But the underlying principle does not change. If you pay 10 times what a business is worth, you will lose money. It does not matter if that business is making horseshoes or making semiconductors. Overpaying is overpaying. Now, I understand the counter-argument. People say, but these companies are growing so fast, you have to pay for growth. If you wait for a bargain price, you will miss out on the best opportunities. Well, let me tell you something. I have been hearing that argument my entire life. Every bubble, every mania, every period of speculation, people make the exact same argument. And every time, it turns out to be wrong. Growth is valuable, absolutely. But growth does not justify any price. There is a level at which even rapid growth cannot generate enough cash to justify the valuation. And when you cross that line, you are speculating, not investing. Let me give you a simple example. Suppose there is a company growing at 50% per year. Very impressive growth. But suppose it is trading at 100 times sales, not earnings, sales. For that valuation to make sense, the company would need to not only maintain that 50% growth rate for many years, but also eventually achieve profit margins far higher than any company in its industry has ever achieved, and then it would need to sustain those margins indefinitely. Is that possible? Maybe. Is it likely? No. Is it worth betting your retirement savings on? Absolutely not. This is what I mean by staying rational. This is what I mean by doing the math. When you actually sit down and calculate what needs to happen for a valuation to make sense, you often discover that it requires everything going perfectly for many years. And in the real world, everything does not go perfectly. One of the most important skills in investing is the ability to say no. In fact, I would argue that your success as an investor will be determined more by what you do not buy than by what you do buy. You see, there are thousands of stocks out there, thousands of opportunities. or at least things that look like opportunities. Every day, someone is trying to sell you on the next big thing, the next Amazon, the next Apple, the next revolutionary company that is going to change the world. And most of the time, the right answer is no. Not because these companies are frauds, though some of them are, not because they will not grow, though many will not, but simply because the price being asked is not justified by the value being offered. Saying no is hard. It feels like you are missing out. It feels like you are being left behind, especially when you see other people buying and making money, at least on paper. But here is what I have learned. Every time I have said no to something I did not understand or something that was priced too high, I have been grateful later. Maybe not immediately. Sometimes it takes years. But eventually, the truth comes out. The overvalued becomes fairly valued or undervalued. The speculation ends, and the people who said yes at the wrong time are left holding the bag. Meanwhile, by saying no, I have preserved my capital, I have kept my powder dry, and when a real opportunity comes along, when I find a wonderful business at a sensible price, I have the resources to act. This is what I mean by discipline. Discipline is not about forcing yourself to do something difficult. Discipline is about having a set of principles and sticking to them, even when it is uncomfortable, even when everyone around you is doing something different. It is about saying, I will only invest in businesses I understand, and then actually passing on things you do not understand, no matter how exciting they sound. It is about saying, I will only buy when I have a margin of safety, and then actually waiting for that margin of safety, even if it means sitting in cash for months or years. It is about saying, I will think like an owner, not a trader, and then actually holding your investments for the long term, even when the stock price goes down temporarily. These principles are simple, but living by them is hard because it requires you to go against the crowd. It requires you to be comfortable being different. It requires you to have confidence in your own analysis even when everyone else thinks you are wrong. Let me tell you about a conversation I had many years ago. A young man came to visit me in Omaha. He was smart, well-educated, eager to learn, and he asked me, what is the secret to successful investing? What is the one thing I need to know? I told him there is no secret. The principles are not complicated. Stay within your circle of competence. Insist on a margin of safety. Think long term. Be patient. Be disciplined. That is it. That is the whole game. He looked disappointed. I think he was expecting some complex formula, some sophisticated strategy, some insider knowledge that would give him an edge. So I told him, the principles are simple, but living by them is hard because it requires you to control your emotions. It requires you to resist temptation. It requires you to do nothing when everyone else is doing something. And that is the truth. The hard part of investing is not the analysis. The hard part is the psychology. The hard part is controlling your fear and your greed. The hard part is being patient when patience seems foolish. The hard part is being rational when everyone around you has lost their minds. If you can master that, if you can stick to sound principles even when it is uncomfortable, you will do well. Not because you are smarter than everyone else, not because you have access to better information, but simply because you avoid the mistakes that destroy most people's wealth. Now, let me address one more common objection that I hear, particularly from people who are frustrated with the approach I am describing. They say, Warren, your approach is too slow. If I follow your advice, it will take me decades to build real wealth. I do not have decades. I want to get rich faster. And I understand that feeling. I really do. When you are young, when you are just starting out, decades seem like an eternity. You want results now. You want to accelerate the process. But here's the problem with trying to get rich quickly. The strategies that promise fast returns are almost always the strategies that carry enormous risk. They are the speculative bets, the leveraged plays, the attempt to time the market perfectly or find the next 10 bagger. And yes, sometimes these strategies work. Sometimes people get lucky. They buy the right stock at the right time, and it multiplies several times over in a short period. And those people tell their stories, and those stories spread, and they make it seem like fast wealth is easy and attainable. But what you do not hear about are all the people who tried the same strategy and lost. What you do not hear about are the thousands of investors who bet big on speculative plays and saw their capital evaporate. What you do not hear about are the years of hard work and savings that disappeared in a matter of months or even days. The financial media loves to tell stories about people who got rich quickly. Those stories are exciting. They are dramatic. They make for good headlines, but they are not representative of reality. For every person who gets rich through speculation, there are 100 or 1,000 who lose money. The tried and true path to wealth, the path that actually works for most people, is slower. It is less exciting. It does not make for good cocktail party conversation, but it works. You save 10 or 15% of your income every year. You invest it in solid businesses at reasonable prices. You reinvest your dividends. You leave it alone for 30 or 40 years. And at the end of that period, you have real wealth, not lottery ticket wealth, not get-rich-quick wealth, but sustainable, lasting wealth that can support you and your family for the rest of your lives. Is that exciting? No. Is that glamorous? No. Does it work? Absolutely. The miracle of compounding is the most powerful force in finance, but it requires time. It requires patience, and it requires that you do not interrupt the process by making foolish speculative bets along the way. Let me give you one final piece of advice, and this might be the most important thing I say to you today. The quality of your life as an investor will be determined by the quality of the businesses you own and the prices you pay for them. That is it. That is the whole game. Not by how often you trade, not by how sophisticated your strategy is, not by how much time you spend watching financial television or reading market commentary. Just two things: the quality of the businesses and the prices you pay. So when you are evaluating an investment, ask yourself these questions. Is this a good business? Does it have a durable competitive advantage? Does it generate strong cash flows? Does management allocate capital wisely? Do I understand how it makes money? And then ask yourself, what is a fair price for this business? What is it actually worth? Am I buying with a margin of safety? If you can answer those questions honestly, and if the answers are favorable, then you have found an investment. If you cannot answer those questions, or if the answers are unfavorable, then what you are looking at is speculation, and you should walk away. It is that simple, and it is that hard. Now, I want to close with a thought that I hope will stay with you. Investing is not a competition. You are not trying to beat other investors. You are not trying to outsmart the market. You are not trying to prove how clever you are. You are simply trying to grow your wealth at a reasonable rate over time. That is it. That is the goal. And here is the beautiful thing. If you avoid the big mistakes, if you do not lose money on speculative nonsense, if you stick to sound principles, you will do better than the vast majority of investors. Not because you are a genius, not because you have some secret strategy, but simply because you avoided the traps that catch almost everyone else. The biggest trap, the one that destroys more wealth than any other, is confusing speculation with investing. It is buying things you do not understand at prices that make no sense. hoping that someone else will pay you more tomorrow. Do not fall into that trap. Do not let fear of missing out override your rational judgment. Do not let greed cloud your analysis. Do not let the crowd pressure you into making foolish decisions. Stay within your circle of competence. Insist on a margin of safety. Think like an owner. Be patient. Be disciplined. And most of all, be honest with yourself. If you do these things, you will not get rich overnight. You will not have exciting stories to tell at parties. You will not be featured in the financial media as the next great investor. But you will build real, lasting wealth. You will sleep well at night. You will not lie awake worrying about whether your speculative bets will pay off. You will have confidence in your investments because they are based on sound analysis and reasonable prices. And decades from now, when you look back on your investing career, you will be grateful that you took the patient, disciplined approach. You will be grateful that you avoided the speculation trap. You will be grateful that you built your wealth on a foundation of sound principles rather than hope and hype. I am 85 years old now. I have been investing for more than 70 years, and I can tell you with absolute certainty that the principles I have shared with you today are timeless. They worked in the 1,950 seconds. They worked in the 1,990 seconds. They work today, and they will work 50 years from now. The world will change. Technology will advance. New industries will emerge. Old industries will decline. But the fundamental principles of sound investing will remain the same. Value matters. Price matters. Understanding what you own matters. Having a margin of safety matters. Being patient matters. Being disciplined matters. Everything else is just noise. So I encourage you, do not be seduced by the siren song of speculation. Do not chase hot stocks or the latest fads. Do not try to get rich quickly. Instead, commit yourself to the patient, disciplined accumulation of wealth through sound investing principles. It is not glamorous. It is not exciting, but it works. And in the end, that is all that matters. Thank you for listening to an old man from Omaha share what he has learned over a lifetime of investing. I hope you will take these lessons to heart. I hope you will avoid the mistake that has destroyed so much wealth over the years. And I hope that decades from now, you will look back and realize that the decision to invest rather than speculate was one of the best decisions you ever made. Now, go forth and invest wisely. The future belongs to those who are patient, disciplined, and rational. Make sure you are one of them.